I'm going to go over one of the questions I get asked a lot about why the stock market hasn't gone down as much as people expect as a result of COVID. Now, it did go down a lot the very first month in March when the entire world went into lockdown last year in 2020. Both the Toronto Stock Exchange and Dow Jones fell about 35% in 1 month. The dramatic impact, okay, just in 1 month. But there was a pretty quick recovery as well. And by the end of 2020, the markets had recovered to pre-COVID levels for the most part. It's the stock market as a whole. Even though we're still not out of the COVID lockdowns in various parts of the world. Vaccines haven't been distributed. So why has the market recovered, and why hasn't it gone down further? So initially people thought maybe it's an overvaluation and it's going to crash again, and nobody really knows. I mean, the first month was an emotional reaction because it was the first time we ever experienced anything like this. But if you look at pure fundamentals and why it has recovered. The simplest way is to do a simple example here. So I'm going to do this example using Walmart. Now I very roughly made these numbers up just to kind of back into what the value of these companies was around the time of the pre-COVID crash. Okay, so the way I came about it was I looked at the net income of the company, and I discounted it back to what should the company be worth based on that income. Because if you look at fundamental valuation, the value of a company is going to be the present value of all of the future cash flows. So if I take all of the cash flows that Walmart will earn forever and I convert them back to today's dollars based on a discount factor, then that's the value of Walmart. And if that cash flow changes, then the value of Walmart will change. Now for the sake of just picking a number, I took it up to 2099. So we went about 80 years in the future. And all I did was I started with Walmart net income of 15 billion, and I added 3% every year. And I said I would discount it by 7%. I just sort of picked that number because it's reasonable, and it came roughly out to what Walmart's valuation was. So what that means is investors who buy shares of Walmart would be expecting 7% a year as a return. And that's not unreasonable. Okay, so this comes up to a valuation of $128 per share. Okay, so I think the share price before was in the low 100s, so it was not dramatically off. Now, it fell, or the market fell by about a third in 1 month. Okay, so what should happen? Now, this is just one company, but what should happen to make Walmart fall by a third? Essentially, what I would have to do is I'd have to take its income of 15 billion and drop it by a third. I'm going to make it 10 billion. And then that translates forward as well, because that's the base and it's going to grow by inflation every year. And you can see as a result of all of that, the share price drops to $85 and we have a decrease of 33%. Okay, so that would justify how severe a market crash would need to be to justify a 33% market crash forever, not like a 1 month. 1 month is an emotional issue. So if at the end of the year it still stayed at negative 33, it's because the investors are thinking that all of the shares income, or all the company's income in the future is going to be 2/3 of what we had expected. And that's a pretty big number. Okay, so what happens in reality is, what if it went down to 10 million for a year and then we go back to its pre-COVID number of 15? So you have one bad year. You can see then the result is not that dramatic. It's only 4%. So in order to get a full drop of 30% plus, it has to go all the way across forever. So in certain companies like Walmart, you would not expect a drop of 33% for eternity. You might expect the fact that, okay, well, they'll have lower sales for a year or a couple of quarters because of limited capacity in their stores and things like that. And as a result, you would see some decline, but nothing as dramatic as we would think. emotionally we would think it'd be large because we're all, for the first time in history, we're locked up in our houses and can't go out. So you would think it would have to be a catastrophic effect on the market. But you can see financially it wouldn't be.